Good morning, ladies and gentlemen, and welcome to the SERINUS Energy PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab, just situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and if you give that your kind attention, I'm sure that'd be highly appreciated by the company. I'd now like to hand over to CEO Jeffrey Ord. Good morning, sir.
Good morning. Thank you. Good morning, everyone. Welcome. This is our presentation to present the financial results for the 6 months ended the 30th of June 2022. I'm joined on the call today by Andrew Fairclough, our CFO, Stuart Morrison, our Chief Operating Officer, and Calvin Brackman, our VP of External Relations. Andrew, first page. As we normally do with these presentations, I will begin with a bit of an operational review. I'll hand over to Andrew for the bulk of the presentation, going through the financial results, and then I'll pick back up at the end to give some concluding remarks, and then we'll answer some questions. Production for the period was 1,006 barrels of oil a day equivalent. That's down marginally from the production in the first quarter. One of our compressors, a pneumatic starter engine, had a stripped gear, so we lost 6 days of production there while we got that replacement part from, of all places, England, and had it sent to Romania and replaced. We also have the 1003 well, which is waiting an intervention. At that point, when we do the intervention, we'll look at some of the behind pipe gas. So that's gas in zones that we haven't perforated in that well. So we're reviewing going back to reperforate and have that well produce. Big work for us in the quarter has been getting to the Romanian wells. We're currently waiting on cement to dry in the first section of the Canara 1 well before we'll drill further. So that well is drilling. That was spudded on the 4th of August. I think many shareholders expected us to spud that a little bit earlier. I think we did too. We had difficulty getting trucks in Romania. A mobilization of a rig usually takes us about 4 days. It took us 3 weeks. Trucks are occupied either taking things into the Ukraine on behalf of NATO or bringing wheat out of the Ukraine. So about 80% of the trucks in Romania are contracted. So when we're moving 48 truckloads of equipment up to mobilize a rig, getting trucks was important, and there's a very, very tight truck market in the region. That well will be drilled to 1,600 meters. It's targeting 3 zones. It's about 4 kilometers away from the Moftino gas plant. So upon success, that one's fairly quick to tie in. Immediately upon drilling that, completing the drilling, the rig moves to the Moftino Nord 1 well, which is almost due north, a little bit northwest of the Moftino gas plant. That'll be 1,000 meter well, again targeting 3 hydrocarbon zones. Those wells are pretty quick to bring on stream, so pending success, we would hope to immediately begin building tie-in lines and take those back to the Moftino gas plant. Next page, Andrew, please. In Tunisia, we have talked about the W1 program for a long time. As everyone knows, global supply chains and logistics kept that pump from being delivered for the large part of 2021. We got that pump in March of 2022, at which point we signed a rig contract with the monopoly government-owned drilling company, a company called Compagnie Tunisienne de Forage, or CTF. That company is 80% owned by ETAP, our partner, and it is a government-owned company. Rig contract was signed as soon as we had certainty on the pump. Obviously, we didn't want to sign a rig contract and be committed to a rig when we didn't know when that pump was going to be able to get into the country. So we signed the contract immediately upon having certainty on the pump. That committed CTF to deliver the CTF 006 rig once it was mobilized from another operator. CTF has defaulted on that contract and is unable to deliver that rig to us. We are in conversations with our partner, the ministries, the government, all the way up to the president, about what it means when a government drilling company is unable to fulfill its contract. The government is extremely concerned and is working very hard with us to find an alternative rig. However, at this point, I can't tell you when we will get an alternative rig. The sites are all prepared. All of the equipment is in our warehouse. We are ready to go as soon as the Tunisians can provide us a rig. This is serious enough for the state of Tunisia that they're looking at importing rigs from outside the country, which they've never done before. So it's a big issue. Unfortunately for us, it means we're sitting still waiting on that rig. We have been given a lot of assurances by the government. Some of them have been fulfilled, some of them haven't. It's a difficult position with the government right now. Anyone who's followed Tunisian politics will know that there was a referendum on the 25th of July, which handed a lot of powers to the president of Tunisia. It's a very controversial referendum, and it's made political institutions in the country and bureaucratic institutions in the country move very, very slowly with the uncertainty as to what's going on with the overall political circumstances. Now, obviously, we want to get, that's a very material work for us. It has a really material increase in production. It's material for ETAP. So our partner, the government oil company, the national oil company, is eager to get this done. Everyone would like to get this done. Immediately upon completing W1, we have a workover plan for N2. Now that's the well that was damaged originally when it was drilled. We're going to clean that well out. It's adjacent to Win 12, which is our best producer. And so we think that that's a very, very good opportunity to, again, do some fairly basic oil field block and tackling to increase production. Production remains stable at Shwesha Saida. So that's the southern fields that we own 100%. We're doing a workover right now on CS9, one of the wells, and we expect that to be back on stream fairly quickly, and that'll boost production. When we've done these workovers, when we've cleaned out or replaced pumps, we immediately see the uplift in production. So I think it's telling that the 100% operated fields in the south, we're moving ahead, we're moving forward. The 45% operated fields at Sabria, it's a bit more difficult with our partners being the government. Next page, Andrew. Obviously, there's been some very large disruptions in the gas markets in Europe. I would like to say that we originally set up our trading company in Romania to take advantage of disruptions in the European gas market, but that's not the case. We didn't have that kind of foresight. We set up a trading business to take control of our own trading. With these disruptions, our trading business, as you'll see from our netbacks and from our after-tax cash flow numbers, the trading business is doing very, very well. It trades about 50% of our gas. The rest goes to Vitol. That 50% that we're trading on, our traders are making an incremental margin for us. So the disruption is real. It's not looking like it's going anywhere. Gas prices remain very high in Romania, and our traders are taking advantage of that. We are looking forward to the gas markets. We are hopeful that our 2 exploration wells will be successful and have more gas to market. But like I say, our Romanian traders are doing an excellent job. So I'll take that as a bit of an operational update. I'll hand it over to Andrew to go through some of the numbers, and we can pick up this at the end and answer some questions. Andrew?
Great. Thanks, Jeffrey. Look, we've had a very strong first half of the year. Revenues just over $29 million. And we're seeing generating very strong cash generation. Funds from operations, 8.2 million. EBITDA, 8.1 million. And we generated gross profit of $8 million in the first 6 months of this year. Gas pricing and oil prices have both been beneficial to us and been very strong. The group average realized price is nearly $155 per barrel of oil equivalent. That translates to an oil price of over $101 per barrel and a realized gas price of $33.80 per MCF. Operating netbacks as a sort of measure of our performance, again, extraordinarily high. For the 6 months ended June, that was nearly $113 per BOE. That translates to Romania operating netback of in excess of $171 per BOE. And in Tunisia, the operating netback was nearly $63.5 per BOE. So a very strong first half of the year for us. The strong cash generation of the business is allowing us to invest and continue to invest. And as Jeffrey said, we have a drilling program coming up. In the first half of the year, we spent $4.2 million. The bulk of that was in Romania, $3.5 million, which related to the compression in the first quarter. We completed the 2D seismic program and the analysis of that, and also preparations for the drilling campaign that is now underway. Working capital improved to $2.8 million, and we closed the period with $7.2 million of cash in the bank. We're due to do a lifting later this month in Tunisia, which again will reflect going through into the next half of the year. I think it's worth again reminding everybody the strength, the stability of the platform that we have created over the last number of years. The revenue, strength in revenue is translating very much into strong cash flow. The cash flow is allowing us to invest. And the principal reason for that really is the fact that we have a very tight control of costs, and also the exercise that we went through to clean up the balance sheet, eliminate all of the debt, puts us in a position where we are able to reinvest that cash flow into the business with a view to the future and the future growth of the business. Again, you know, we're generating another quarter of net income, which is a reflection of so many of the actions that have been taken to date in the last few years. Looking at the sort of revenue and cost of sales, revenue, 66% of revenue was generated in the first half in Romania. As I said, we did a lifting in April in Tunisia, and we've got another one coming up later this month. Cost of sales has increased very much due to higher windfall taxes. You can see windfall tax in that half year was $9.7 million, which was up against the comparative period, which was $1.7 million. Operating costs are up a bit, and that is also offset by a lower depletion depreciation. Gross profit in the period, nearly $8 million. And again, as I just said, that's translated into another quarter of positive net income. Jeffrey's talked about production. I think the key thing for us is the drilling campaign that we've got in Romania, with 2 wells coming up back to back, with the first well already having spudded on the 4th of August, and Tunisia remains stable. Average pricing, as said in the introduction, is very, very strong, nearly $155 per BOE at the group level. The average Romanian gas price in the period was nearly $37 per MCF. And the average oil price, as already said, was over $101 per barrel. So a very strong positive environment that we're able to capitalize on at this point in time. Production expenses, this did increase against the comparative period. Tunisia remains 2.4, still reflects lower workover costs that equated to $24 per BOE. In Romania, we're seeing very high inflationary impacts. We're seeing a number of key elements of our cost base increase with, for instance, propane costs there have increased over 68%. Electricity at the gas plant is 67% higher. Generally, fuel costs across the board nearly 40% higher. So the impact of inflation at this point in time is reflected in these costs. Nevertheless, again, you can see the strength and the cash generation of the business, the strong operating netbacks. over $113 per BOE at the group level, and again, $63.5 per BOE in Tunisia, and really a very strong reflection of the Romanian business. You can see that in the $171 per BOE netback there. As I said, CapEx, you can see the breakdown of CapEx there, and I've already discussed that the bulk of that was coming through Romania, very much a product of our ability to reinvest in the strong cash flow generation of the business that is allowing us to invest and continue to invest in the business. Funds from operations, that's the whole driver, $8.2 million in the period, with EBITDA of $8.1 million. So a very, very strong set of financial results. We're in a very strong financial position. We've got an ability to invest and continue to invest in the business, and we have the work programs ongoing and identified to continue to do that. And with that, Jeffrey, if I hand back to you.
Good. Okay. Look, giving a quick summary, I think that the business is progressing. Obviously, we've seen a delay in Tunisia with the unavailability of a rig that's been frustrating. Nonetheless, the opportunities are still there. We have an excellent resource base. I think that we look at the resources in Romania, where we have 181 million barrels of prospective resources. These two wells that we're drilling now open up some of that resource, and we would just, we want to get on with the growth. The cautionary side of this, inflation is high. I think we all hear about it in the news. I think we all hear about a cost of living crisis. Andrew gave a couple of examples, but rolled steel, the tubulars that all oil companies use for their casing, their drill pipe, the basic steel that we use has gone up 300%. Now, we've managed to buy in advance. We've got about 6 kilometers of tubing sitting in warehouses. So we're in a position to be able to handle that. But when you hear on the news about these fantastically high commodity prices, what they fail to mention is it comes with an increase in cost. And I hope Andrew gave everyone the understanding that one of the things we focus on most is that cost. If we can control that cost, if we can keep that cost down, if we can work ways around inflation, like buying tubulars early, like having tubulars in inventory, then we can have a widening margin. That margin for us is bigger. So it's a very, very much a focus on cost right now. The business is continuing along. We're very much looking forward to planning our future drilling program to release some of that 181 million barrels of prospective resource in Romania. And we're very, very eager to get some of these pumps going in Sabria. We know that the pumps work because we have them all working in Schwesh, and we've seen what that does there. So again, we're moving forward with that. So I think the summary is strong financial quarter, strong financial half. Commodity prices most certainly helping. And the cost control remains a big focus so that we make sure that we get the most out of these high commodity prices. The good news for a producing company is it doesn't look like there's disruptions to the high commodity prices coming in the near future. So we will continue to produce. We'll continue to generate the cash, and we'll continue to invest in these very high return assets that we have. Andrew, next page. I think we've gone through this one. Next one. Of course, we should talk about health and safety. We continue to run the business as safely as we possibly can. We've had no lost time incidents. That's when we've been doing some fairly heavy operations. And for a company of our size, getting ready to put pumps in Tunisia, getting surface works and all the civil works prepared, getting 2 wells ready to go in Romania, that's a lot of man hours that we put in. We continue to operate safely with no lost time incidents. We do have solar facilities at the Moftino gas plant. We run solar panels on the top of all of our buildings there. And more recently, we're looking at a solar facility within the Sabria compound that would help to power the plant there. So we're moving along with reducing emissions from generators fugitive gas emissions, as everyone should know in this company, have been audited by third-party independent consultants for over 10 years. So we monitor our emissions, we keep our plants clean, and we make sure that everyone's working safely and well. Next page. So I think we've summarized fairly clearly. This is a very, very strong financial period for us. We continue to work on our asset base. We'd like to open it up even more. We believe these are high return assets. We know that when we do, we've shown the returns we can get, and we just keep working the business on that basis. I think that is all we'd have to say. I thank everyone for joining the calls, and I guess we'll move to questions now.
That's great. Jeffrey, Andrew, thank you very much indeed for updating investors this morning. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of the screen. But just while Jeffrey and Andrew take a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. Jeffrey, Andrew, as you know, we had a number of pre-submitted questions, and as you can see, the number of questions have come in from investors throughout today's meeting. So thank you to everyone, firstly, for your engagement. Perhaps if I may just start off with a few of the pre-submitted questions. The first one reads as follows: are the company directors and officers benchmarked to a recognized standard, and if so, which one?
Yes, we are. In terms of governance, the company follows the Quoted Company Alliance QCA code. And in terms of remuneration, our remuneration committee has a third-party consultant that annually reviews our compensation and benchmarks that against peers, both at the non-executive director level and at the executive level.
That's great. Thank you. Let me turn to the next one. In the event of a commercial discovery, how long would it take to connect this to the gas plant?
We always quote the distances, and you're right, we don't quote the times. The reason we do that is because the time to connect the well will differ by the time of year, and that's simply a weather effect. So as we're looking right now, we would be, in the event of success on Canard 1, we would be doing an autumn tieback to the plant when it would be fairly dry, crops would be off the fields, and we could move fairly quickly. That would probably be about 3 months. If we were in early spring, when it's quite wet, it would probably be 2 more months. Just getting your heavy equipment to dig trenches and to lay tie lines adds some time because it's muddy. And of course, you don't want to be doing that in the middle of summer when everyone's crops are on the field, because it does get fairly expensive to pay for the crops that you destroy when you put the lines through. So there is some seasonality to it, but I would say 3 to 5 months, depending on that seasonality.
Thanks, Jeffrey. What is the expected Bopd output following the Tunisia workover program?
On the first well, on our corporate presentation, there will be a table that shows, and I'm sorry, I don't have that in front of me right now, that shows what third-party engineering believes the incremental production would be from each well. So the W1 well, and Stuart, you might want to correct me if you have better numbers in front of me, that the incremental production is about 356 barrels of oil equivalent. So it's a well that's currently not producing anything. So it's an incremental 350-ish, 356, I think is the number off the top of my head.
Sorry, Jeff, just jump in there. The oil increments of the order of 540. The 350 to 500 is more for N2.
Sorry, N2. So, Stuart, those numbers were for W1, the number was?
540 oil plus some gas, giving a BOE rate of a bit under 800.
So
we have a net 45%.
Yeah, so that's a gross number. So net 45%. But remember, that well is currently not producing. So it's a very, very material upside.
Yeah.
Thank you, guys. Let's turn to the next question. Investors before the presentation can read that the focus of the company is to enhance shareholder value. For the last 5 years, the board was paid in line with more than the market cap, and UK investors are down on their initial investment. So can you kind of just perhaps give a little color around enhancing shareholder value, I guess?
Well, I think everyone's frustrated by the share price. I mean, Andrew talked about having a lifting next week. We have about $6.5 million of cash. We do a lifting, the size of the April lifting. We will have significant amounts of cash, and the market cap, the equity value of the business certainly does not properly value 1,000 barrels a day of production coming out of our assets. As to the board being paid, well, over 6 years, over the life of this company, I'm guessing that is the case. I haven't done that calculation. However, I would say that the $90 million of revenue that's come out of Moftino alone on a $17.8 million investment, that's value. The cash value has allowed us to go and do incremental production, and has allowed us to open up some of that big resource in Romania. So I think we're all frustrated with the share price. It doesn't make sense, but we keep running the business as low a cost as we can. We keep generating cash. We keep making investments that return us more than we put in, like Moftino, and eventually, I believe over time that value will show through. But it's very frustrating for everyone.
Thanks, Jeffrey. The final two pre-submitted questions were about the same topic around share buybacks. So I'll just choose to read one. Despite the business' very good cash position, share buybacks were very limited and stopped altogether without notice, and wondered, was there other ways of distributing back to shareholders?
Well, stock buybacks. Firstly, shareholders have authorized the business on a rolling basis. Routinely, we get authorization to buy back 10%. That does not mean the company is going to go buy back 10%. That's a routine authorization that we get. The company manages its cash for its investments. So we have cash available to do the drilling program. And of course, we have to have cash available for the success base, right? So there's two portions of any well. There's the drilling portion to find out if you have something. And then upon success, there's the completion. So you have to put the bottom hole assembly in to be able to produce the well, and the tie lines to get that gas back to the gas pipe. So you have two portions of every well. You have to have the capital available to fulfill both portions. And we all hope that we get to spend that money because that's a successful outcome. So we build our capital programs around the successful outcomes of our drilling. We also have experienced inflation. So whilst everyone sees the revenue going up, we also have our capital programs have gotten more expensive. So we have to keep money aside for that. So we are primarily a growth company. We always have been. These assets return very, very good returns. And so our primary consideration is to invest in the excellent asset base we have. Our primary consideration is not to buy back shares. And as cash flow is a flow, there are periods when we accrue cash, and there are periods where we spend cash. So quite simply, the company builds its cash flow profile to meet its capital programs, to meet its objectives. The share buybacks stopping abruptly, yes, they did, because we're in a blackout period. The company, like the directors, is unable to buy back its shares when it's in possession of material price-sensitive information. The company is bound by the same blackout periods that the directors are. And those blackout periods are largely around the financial results. So the company actually comes out of blackout today as we've released these results. So when we say that the buyback stopped abruptly with no reason, well, no, the reason is the company went into blackout. But we're not looking at a large buyback program at this point. We're looking at fulfilling our investments. We're looking at fulfilling the work programs that we've laid out for everyone, and making sure that we have capital available to do that. And that quite simply is the priority, and has always been the priority.
That's great. Thank you. Well, look, that takes care of all the pre-submitted questions. So once again, thank you to everybody that took the time to submit questions. And if I may, Jeffrey, on the right-hand side of the screen in that Q&A tab, you'll see that you received further questions from investors following your presentation. I wondered if I could ask you just to read out those questions and give a response where it's appropriate to do so, and then I'll pick up from you at the end.
Excellent. The first question, what is the plan to move Serena's trading to the main market? We have no plans to move to the main market. For a company of our size, we report to main market standards. That is, we do quarterly reports and we do annual reserve reports. We believe that reporting standard gives all the information that shareholders need. But we have no plans to move to the main market where prospectus rules would make any eventual or distant requirement to raise cash more difficult. And then be clear, we're not suggesting we're looking to raise any equity. We're not. But of course, one of the benefits of AIM is the quick ability to do that. Moving to the main market for a company of our size, it wouldn't be appropriate at this stage. So we're not looking at plans to do that. Looking at current production in Tunisia in relation to reserves, it would look like the reserves are for more than the next 20 years. Taking your experience in Tunisia so far with drilling monopoly there, could you provide your best guess at how long it will take to exploit all the current reserves in Tunisia? At the current rates, you're right. It would take a long time. As to the actual number, it will take more than 20 years. And that really is the whole point of our asset in Tunisia, is we need to accelerate that production. No one needs a warehouse of 20 years of oil, certainly not a small company like us. We need to increase that production, and pumps and eventually new wells are the way to do it, to reduce that. I've always said that a small company shouldn't have a reserve life of anything more than about 8 or 9 years. So we need to reduce that number by increasing the production side. And that's what we're attempting to do. Remember, that field's been producing since the 80s. And that field, Sabria, has 445 million barrels in place, of which 1% has been produced, right? That's not a complicated, it's a conventional oil field. So it should have a much higher recovery factor right now. And so that's what we're trying to do, is we're trying to accelerate the recovery factor. And Tunisia is a difficult place to work, but that's a real prize that we have out there, is we have this large asset. We really do need to get on and accelerate the development of it. And I think that our partner ETAP understands that. We need to get going on this pumps. ETAP is behind us, and it's just regrettable that there are only 4 rigs in the country. And they need more rigs. This is sometimes what government monopolies can do. They can restrict you when you really need to be unrestricted. So this is an excellent question about that Sabria resource and how we get that production up, so we reduce that reserve life, so that we don't need to wait 20 years to get all the value up. Next question: are there any probable or possible changes in tax regulations for better or worse? We have no discussions with any of our governments, our host governments right now, about tax changes. We were in conversations with the Romanian government about a reduction in the windfall tax to encourage more onshore gas production to help with energy security, given what's going on with European gas prices. I think those are important discussions. I think Romania is starting to realize that actually this windfall tax, and you saw in Andrew's numbers, more than $9 million have been paid by SERINUS in windfall tax. That money could have been invested in Romania to build their gas production, to help their energy security. So one of the things that's come out of this high European gas price environment is the understanding from countries that actually we need to have reinvestment. We need to have investment going to build the gas production. And that ultimately is good. But no, currently we are not in any discussions, nor are the governments considering any additional taxes. What is the impact of inflation on demand for oil? I think this is sort of a global question. Look, it always we know that inflation and slowing of GDP has an effect on demand. We know specifically for us that we have not seen any reductions in demands in our markets. So even at higher oil prices, when we were up at 120, 130 for that brief period of time, we did not see demand destruction from price, and we are not seeing any demand destruction from worries about recession. So demand destruction for oil right now is we are not seeing, and obviously everyone sees the gas price at these very, very high prices. We are hearing fertilizer plants are shutting down. We're hearing chemical plants are shutting down, but we're not seeing that come through in price, which means we're not seeing it come through in demand. So it haven't seen it yet. The windfall tax, again, another quick question. Is there any realistic chance of this changing? Government's 8 or 9 million just means they take most of the jam. That's exactly, but I wouldn't say they take most of the jam. We increase our take at a decreasing rate. So even though the price goes up and even though their take goes up, our take still goes up as well. So it's a disproportionate sharing of the jam is what I'd say. Is there any realistic chance of this changing? Yeah, I actually think this is, because we've spoken to all the ministries, Ministry of the Economy, Ministry of Energy, Ministry. We've spoken to all of the ministries. We've had a big press out there to talk about why reinvestment is the basis of energy security. And I think that message is actually starting to get through, that Romania realizes that they have plenty of gas resource. We talk about the 181 million barrels of oil equivalent on our block alone. Incentivize people, give them an incentive to go extract that resource, and you enhance your energy security. So is there a realistic chance of this changing? Yeah, I actually think there is, wholly on the basis of energy security. If Romanian drilling successfully finds material production capacity, how much CapEx would be required for production? This is what I referred to as, the completion cost versus the drilling cost, and the tieback cost. Andrew, do you have the accurate numbers for the drilling portion, the completion portion, and the tie-in portion?
Yeah, so it's approximately, sorry, it's not what detail, but it's about, for the flow lines, it's about $500,000. Completion testing is about $1 million, and for the drilling, that's about, at least, it's about $3 million.
Yeah. Okay. What kind of crops are growing in the Moftino area? Is there agricultural activity around your Tunisian assets? In Moftino, there's been agricultural activity for probably the last 3,000 years. There's Roman farms, ruins of Roman farms. The crops they grow are sunflowers and sunflower seeds, a bit of wheat, and a lot of corn. So yeah, there's crops. We have to be careful of the crops. We drive trucks over the crops. We own those crops. So land damages are an important feature of how we operate in Moftino. It's a very fertile farming area. Lots of farms. They're very, very small, sort of postage stamp farms. Lots of little roads, so access by farm roads is easy. But yeah, there's lots of crops growing around Moftino. Primarily corn, sunflower, and a bit of wheat. Is there any agricultural activity around your Tunisian assets? There's an occasional date farm, but it's pretty barren and empty out there. I always joke that it looks like Star Wars, the Luke Skywalker's planet in Star Wars, because that's where it was filmed. And if you watch Star Wars, that's kind of what the terrain looks like where we are. Given the impact of installing the pumps in Tunisia, will you update the market once a rig is secured? We will update the market as best we can. We are negotiating with a host government and a host government that is defaulted on a drilling contract. So there are some political sensitivities. We don't want to inflame a situation. We've had to tell the Tunisians that we would be announcing that they've defaulted on the contract this morning. We've been negotiating with them. They've been trying to do their best to find a solution. So the answer to the question of will we update the market? Yes, we always update the market every time we have news that's important, with the caveat that we are negotiating with a host government, and we have to be guided a bit by them. Given the success of upcoming programs in Romania and Tunisia providing substantial cash from operations, do we already have intensive plans beyond? Would it be the organic development of Romanian and Tunisian assets, or buying new concessions or acquisitions? Yes, we do have a 5-year plan. Every October, the executive team meets and builds our 5-year strategy. And we present that to the board in November at the same time we present our budgets. So the board gets an annual budget, but they get a 5-year plan. Those plans obviously develop. Successes or failures will steer you in one direction or another. We are currently engaging a third party to do a full review of our Satu Mare concession in Romania. We have been focused around the gas basins that we're in, adjacent to Moftino, but of course, it's a 3,000 square kilometer block. And so we're stretching out now to look further afield. And to do that, we've engaged a third party for 2 reasons. One, our capacity is focused on our near-term opportunities. And 2, we would like a sort of a sober second look. A third party taking a look at our work and saying, yes, that's right, or we think this might be different. So we're expanding in Romania, looking further afield. In Tunisia, we have a very, very large field. We have enough work in Tunisia that we would not look to add assets. Certainly at these, at these prices, we just want to focus on the asset we know. So 2 very substantial asset bases. We've always looked. It would look. We've always thought that we would like to bolt on other pieces. We're sort of watching for those pieces, but nothing on the plans right now. And I think that is the end of the questions we have.
Thank you very much indeed, Jeffrey, and indeed you've taken pretty much all the questions that are coming from investors today, and thank you once again to everybody for your engagement. Jeffrey, Andrew, I know that investor feedback is particularly important to the company, and I'll shortly redirect those on the call to give you their thoughts and expectations. But I wondered, before doing so, if I may, Jeffrey, just ask you for a few closing comments before I redirect investors to give you their feedback.
Yeah, look, very briefly, I think we've gone over things pretty extensively here. Very briefly, very strong financial quarter and half year, not just driven by commodity prices, but by steering the company through some fairly high levels of disruption. The inflation we've seen has been, to be honest, quite remarkable in my career. I've never seen inflation quite like this. So strong financial quarter. The second half of the year is when our operations really kick in. Canar kicked it off. We're drilling that now. Moftino Nord comes next. We're really looking forward to getting a rig and getting those pumps in Tunisia. And then we'll go from there. So there's lots of opportunity ahead of us. Very strong financial results. Cash flow is fantastic right now. And operations are progressing as fast as we can move them.
That's great. Jeffrey, Andrew, thank you once again for updating investors this morning. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can really better understand your views and expectations. This may take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of SERINUS Energy PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and may I wish you all a very pleasant morning.